Hello everyone, happy snow day. I'm putting together a video because we only have a few class periods left before we need to start reviewing and taking the makeup exams for the midterms, and then we have finals week. And so I wanted to go ahead and finish up topic 9 and then begin topic 10. I'm making this video for both the evening section of BU 381 and in the morning section of BU 381. Where I start off might not be identical to where we left off in the notes. You might hear some noises around me as I'm recording. My kids also have a snow day today, so everybody's home. I'm going to start with the end of topic 9. So I'm going to start here with the discussion of the capital asset pricing model. I believe we've covered this in both of the sections, but I wanted to make it a point where I know that we're at in both sections of the class. So just as a short review, we were talking about the capital asset pricing model. The assumption of the capital asset pricing model is that diversification can eliminate the unsystematic or firm-specific risk from the portfolio. So in the mid-1960s, Traynor, Sharpe, Lintner, and Mosen independently developed the CAPM, or the capital asset pricing model. The basic premise of the model is that since unsystematic risk can be diversified away, and this was the firm-specific risks we were talking about in class, things like product liability or product obsolescence, rational investors will hold diversified portfolios to eliminate unnecessary risk. So by combining different investments and different stocks together that have different risks, or as specifically different firm-specific risks, by combining many of them together, we eliminate as much as possible the effects of firm-specific events from our overall portfolio. So the idea of the capital asset pricing model is that only systematic risk should be rewarded because we can eliminate all the unsystematic risk. Based on this idea, the CAPM says that returns for all assets can be calculated based on their sensitivity to market risks using the security market line. And we calculate the security market line as the expected return for a stock is equal to the risk-free rate. And so that usually that's going to be a U.S. Treasury bill or a U.S. Treasury note. The risk premium for the market is the market risk premium. This is also sometimes known as the equity risk premium. And beta is the measure of systematic risk for the asset. So what is the market risk premium? The market risk premium is the required rate of return on the average investment in excess of the risk-free rate. We often use the Standard & Poor's S&P 500 index as a measure of the quote-unquote market. So for example, if the risk-free rate is 3% and the expected return on the S&P 500 is 10%, then the market risk premium is 10% minus 3%, or 7%. The market risk premium is a forward-looking number, so we don't typically take historic returns for the market, at least not for an individual year. So we might not look back on the last year and take the return for the S&P 500 to use that as the market return. And the reason why we don't do that is because this is a forward-looking number, and last year's returns may have been extremely high, or they may have been negative. And so that would certainly a negative return for the market we wouldn't want to use here, because then we would say that the market risk premium, the return that investors require over the risk-free rate, is negative, which wouldn't make any sense, because as investors we wouldn't buy investments that we expect to give us a negative return. And so it's usually based on long-term historic returns or a projection of what analysts think the market's going to do in the future. Aswath Damodaran has a website where he forecasts the equity risk premium, which is the same as the market risk premium, every month. I went through in class how to draw the security market line. Just remember that it's this equation that makes the line, and that we use the slope-intercept form, where the risk-free rate is the y-intercept, the market risk premium is the slope, and the beta is the x value. So what I wanted to do was finish up with this for this section of notes, where we calculate the expected return for each of the following stocks. I've got a calculator here that allows me to do that. Or I had a calculator here. Let me find that. There we go. So what I have here is that the yield on the 10-year U.S. Treasury note, that's the risk-free rate, is 2.20, and the market risk premium is 5.50. So what are the expected returns for the stocks below? I'm going to take the market risk premium at 5.5%, so I'll take 1.82 multiplied by 0.055. To that I'm going to add the 2.2%. So I get 12.21% for Tiffany. For Dollar General, they have a very low beta, and that's because they sell staple goods at low prices, so they don't really get hurt too much. In fact, they generally do fairly well during a recession, but they don't go up much in value during a boom economy. In fact, they tend to go down a little bit when the market does really well. So again, what I'm going to do is take 0.055, the market risk premium, multiplied by 0.31 plus 0.022 to get 0.0391, which is extremely low. And I would question this value in general, because it's very low. It's lower than what you would get on a long-term corporate bond at this time. The next one is Apple. Again, we would take the 0.055 multiplied by 0.83 gives me 0.04565 plus my risk-free rate. So the return for Apple is going to be 6.77%. Gold has a very low beta, and that's because it doesn't really move with the market. So it gives us a return of 3.41%. General Electric has a higher than average beta, or at least when I put together this set of notes, its beta was a little bit higher than normal, and that's because they're in many different industries and tend to shift in and out of industries quite a bit, and those industries oftentimes move with the market. So I'm going to take its beta multiplied by the market risk premium plus the risk-free rate, give me 9.24%. And then finally, Bank of America has a very high beta, and we talked about this a little bit in class. Bank of America's beta is so high because the stock is very sensitive to interest rates and also very sensitive to the economy in general. So their required rate of return is 12.32%. So just one last comment. This is the end of the notes. One last comment I have about this is that we know that beta doesn't always work the best, and the CAPM doesn't always work the best in determining required rates of returns for stocks. You can see here with Dollar General, it's a very low return. Gold might just have a very low return because it is a hard asset. Investors may not require high returns from it. A lot of people see it as a store of value whenever the market isn't doing well or the economy isn't doing well. But the very low returns for Dollar General and even Apple. Apple is somewhat of a risky company, and yet based on the CAPM, it has a very low required rate of return. What subsequent research found after the 1960s, specifically in the 1990s, people really started looking at the capital asset pricing model to determine if it was effective. Two researchers, Eugene Fama and Kenneth French, they still are active today, did quite a bit of research on this and found that the capital asset pricing model does not work very well for individual stocks. They found two other risk factors that, including those in with the market risk factor that we use for the capital asset pricing model. If we include their two other risk factors, it does a much better job. And their two risk factors were size, how big is the company? That tends to have an impact on the required rates of return for individual stocks. And also, if the stock is considered a glamour stock, and companies like Apple would be considered glamour stocks. It's stock that people are interested in. They want to own stock in that company because of what the company does. They're excited about it. And so those stocks over time tend to have lower returns than what are considered to be value stocks, or some people would consider to be distressed stocks. So Dollar General would probably be considered to be a value stock or a distressed stock. People aren't excited about it. It's not in the news very much, and so you can usually make a higher return on a stock like that than you can with a glamour stock. Smaller firms tend to get higher returns than larger firms, and that's in part because they are riskier. So just to let you know a little bit about that, we do use, and the capital asset pricing model has been found to be effective for determining the required rates of return for diversified portfolios. So if we talk about different index funds, we can use the CAPM model to determine what the required rates of return should be on those. But it doesn't always work very well for individual stocks. So that's it for this set of notes on risk and return. Now we're going to move on to the notes for topic 10, the capital asset pricing model. So the weighted average cost of capital is also referred to oftentimes as the hurdle rate, HURDLE. And this is the required rate of return that projects are supposed to be able to earn before a company chooses to accept those projects. So when you think back to when we did the capital budgeting decision-making measures, so the NPV, the IRR, the profitability index, all of those have a hurdle rate, and that hurdle rate is the weighted average cost of capital for the firm. And I used to just say this in class, and I taught this in an MBA class once, and one of the students from that class came to me and said, she really didn't understand what I meant by hurdle rate. So I wanted to show you a quick video of what happens whenever people don't get over hurdles, to give you an idea of what it means by a hurdle rate. So this is best hurdle fails. We won't watch the entire 5 minutes, but it gives you a sense of what a hurdle is. Oh, that hurt. So just as a reminder, these things that they're jumping over or not so much are hurdles. Whoa! All right. So that's what our hurdles are, and that's a demonstration of failing at clearing hurdles. So let's go to the notes now. What we're talking about is the weighted average cost of capital. The required rate of return is equal to the cost of capital. And you'll hear me mention the required rate of return for equity, which is not the cost of capital, or the required rate of return for debt, which is not the cost of capital. So the weighted average cost of capital is the required rate of return on the firm's assets overall. And you'll hear it referred to as the cost of capital, the weighted average cost of capital, or WACC, the discount rate, or just R, and sometimes it's denoted with a K. The cost of capital depends primarily on the use of funds, not the source. So you can have a company that's really risky, and they're going to have high cost of equity capital and high cost of debt capital. And you have some fairly unrisky companies like Dollar General, which their required rate of return on equity is going to be fairly low, and their required rate of return on debt, as long as they don't go into new areas or take on a lot of debt, is not going to be very high. The greater the risk that investors will not receive sufficient reward for their investment, the higher the cost of capital. Financial policy and the cost of capital. The firm's target capital structure is the fixed combination of debt and equity that the firm maintains to finance its assets. So a company, whenever they want to invest in a new project, they're usually going to finance some of that through debt and some through retained earnings. And so the mixture of that debt and that retained earnings that they consistently use is their target capital structure. The weighted average cost of capital is the mixture of returns needed to compensate creditors and stockholders for their investments. We're going to start off with the hard one, and that's the cost of equity. So the cost of equity is the required rate of return on equity. It's the rate of return required by stockholders of the firm. It is difficult to determine the cost of equity for publicly traded firms because it cannot be directly observed. So I probably mentioned in class I used to work for a privately owned bank. We had a CEO that owned 97% of the stock in the company, and he told us what his required rate of return was. He said, my required rate of return is 15%. It was easy to determine what we needed to do to get to his required rate of return. However, most managers just can't go to their owners and say, what's your required rate of return? So if you think of a company like Amazon, even though Jeff Bezos owns a lot of the stock in the company, they still have millions of stockholders that aren't Jeff Bezos. So they can't just go out and ask all the stockholders what is your required rate of return and get a consistent answer. So we can't directly observe the required rates of return on equity. So we have to estimate them. I'm going to go over a few different approaches on estimating the required rate of return for equity. The first approach is called the dividend growth model approach. So if you think back to when we determine the prices of stocks, we use something called the dividend discount model, or the dividend growth model, or the Gordon growth model. They're all the same thing, where we say that the price today is equal to the next expected dividend divided by the required rate of return on equity minus the growth rate. We can rearrange that equation to say that the required rate of return on equity is equal to the dividend yield, so that's D1 over P0, plus the long-term constant growth rate for the stock. I'm using Coca-Cola as an example here because it is a constant growth stock. We would expect it to grow at a fairly constant rate in the future because it is so saturated in the marketplace that it doesn't have a lot of growth opportunities. So in this example, I've looked up, and these numbers are a couple weeks old, but I've looked up the information for Coca-Cola. It had a current price of $50.16, and the dividend for 2018 is expected to be $1.54 for the entire year. So what's the dividend yield for Coca-Cola stock? And so it's going to be $1.54 divided by the price of $50.16. And that's going to be equal to divided by $50.16 gives us a dividend yield of 3.07%. There are many estimates. So with the dividend growth model approach, we have a dividend yield, so it's 3.07. That doesn't change. And now we're going to go through a couple of different ways in determining the growth rate. So one way is to calculate the growth rate in dividends over time. So I'll do that here. The growth rate from 2012 to 2013 we would calculate as 1.22. The dividend for 2013 divided by 1.12 gives us 1.08928, and then I'm going to subtract 1 from that to give me the return, or the growth rate of 8.93%. So my growth rate here was 8.93% from 2012 to 2013. From 2013 to 2014, it's an easy one. It's 0.00%. They didn't grow their dividend at all that year. From 2014 to 2015, it was 1.32 divided by 1.22, and then I'm going to subtract 1 from that to get 8.20%. From 2015 to 2016, it was 1.4 divided by 1.32 minus 1 is 6.06%. And then finally, the growth rate from 2016 to 2017, 1.48 divided by 1.4 gives me, and then again I'm going to subtract 1 from that, gives me a growth rate of 5.71%. So now what I want to do is take the average of this. So these are 5 growth rates. I'm going to add them all up, and then I'm going to divide by 5. So I'll get 0.2890, and I'm going to divide that by 5 to get an average growth rate of 5.78%. So my average growth rate in dividends per year for that 5-year period was 5.78%. Using the historical dividend growth rate, what is the cost of equity? So remember up here, the cost of equity is equal to the dividend yield, so that's 3.07, plus my growth rate. In this case, we're using the historic growth rate in dividends. So it's going to be equal to 0.0578 plus 0.0307 is equal to 8.85%. 0.0885. Oops, sorry about that. 0.0885 equal to 8.85%. So I always like to ask, does this number look right? Does it make sense that this would be the required rate of return for Coca-Cola stock? And in general, yeah. It's a little bit lower than the market average of 10 to 12%, and that makes sense because it is Coca-Cola, a very mature company. And so this required rate of return on its face, so far, it looks like it might be a good number to use. The next approach is using analyst estimates. So here we've used the historic expected growth rate, or excuse me, the historic growth rate. Now we're using analyst estimates for the long-term growth rate in dividends. And the analyst estimates for growth is 7.28% per year based on Standard & Poor's Capital IQ. And so using the analyst estimates for growth, remember this is the dividend yield plus growth. So we want to say that the required rate of return using this for the growth is equal to the dividend yield, or excuse me, yeah, the dividend yield plus the growth rate. So we have 0.0728, that's the growth rate. We're going to add our dividend yield of 3.07% to that, and that'll give us a answer of 0.0728 plus the dividend yield 0.0307 of 10.35%. So these aren't too far from each other. The main problem with the dividend growth model approach, so there's a couple of problems, but the big problem is that it requires companies to pay dividends. So if a company doesn't pay dividends, it might be difficult to use this. Also, if it's not a constant growth company, these estimates may be off by quite a bit, especially if they have very high growth rates in dividends. Coca-Cola's growth rate here is a little bit high, and that is because during this time period they were aggressively repurchasing stocks, which just in doing that is going to increase the dividends per share, because you have fewer and fewer shares that you're spreading the same amount of dividends or maybe a slightly higher amount of dividends over. So that's going to inflate the dividend growth rate a little bit. The second approach we're going to talk about, so the first approach was the dividend growth model approach. The second approach is the SML approach, or the CAPM approach, using the security market line. So just as a reminder, SML stands for security market line. There are three inputs for the SML approach: the risk-free rate, the market risk premium, and beta. Alright, so on your notes there's a couple of mistakes in this area, and I just fixed them because as I was kind of reading through them and talking about them, I noticed them. So my notes here are going to be slightly different, but there's no material change, just some corrections to the grammar. So equity has an indefinite life, and investors have different time horizons. The market risk premium is affected by the time to maturity of the risk-free asset used to determine the risk-free rate. So for example, if you hold your equity investments for 10 years on average and use the yield on the 1-year U.S. Treasury for the risk-free rate, then the market risk premium will not only need to reward you for the riskiness of the cash flows between the risk-free asset and the stock market, but also for inflation and interest rate risk. So as a result, what I use for the risk-free rate in my notes and my calculations is the yield on the 10-year U.S. Treasury note, because that tends to match the average time that a person holds an investment, especially for things like retirement. So the yield on the 10-year Treasury note is currently, and we'll look this up, it's currently 3.068%. Using the yield on the U.S. Treasury results in a market risk premium being between 3% and 7%. Risk aversion in the market increases the market risk premium because if people are fearful of risk, that's risk aversion, they require a higher premium in order to take on risk. What tends to happen is when people become nervous about the economy or the world, they suddenly require higher rates of return to stay in the same investments. And so oftentimes they'll sell off their stocks or they'll sell off their other risky investments, and that actually drops stock prices. So when people get fearful about what's going to happen in the future, stock prices tend to fall because the required rates of return on those investments increase. Remember that the market risk premium is not calculated based on recent historic market returns. Why not? And I mentioned this just a minute or two ago. It's not calculated based on recent market returns because recent returns might have been negative or abnormally large or abnormally high. And so we wouldn't want to use those to forecast future required rates of return, especially if they were negative, because it would give us answers that wouldn't make any sense. So implementing the security market line, the current yield on the U.S. Treasury is 3.068, so I'm going to change that. It changed just a little bit. The Coca-Cola beta is 0.61, so very low, because it is not very sensitive to changes in the marketplace. So we're going to calculate the required rate of return using a market risk premium of 5.76%. So I'll take 0.61 multiplied by the market risk premium of 0.0576. Then I'm going to add to that the yield on the 10-year U.S. Treasury, 0.03068, to get a required rate of return on Coca-Cola stock of 6.58%. So the required rate of return on Coca-Cola stock, based on the security market line, is 6.58%. The disadvantages of the capital asset pricing model: one, it only accounts for market risk. And two, or you might put in here, systematic risk. They mean the same thing. Two, the beta is usually based on historic returns. And so that's where I'm going to stop for today. On Wednesday, we'll pick this up and we will finish the weighted average cost of capital calculations. And so you have an assignment due on Friday. Please let me know if you have any questions about that. And please let me know if you have any questions about the notes I've gone over today. I hope you have a good rest of your snow day and good Tuesday.